WCNY's Financial Fitness is made possible by our members. And by D'Arcangelo and Company, with offices in Utica, Rome, Oneida, and Syracuse. The D'Arcangelo team of CPA professionals specializes in finding ways to minimize your taxes. D'Arcangelo and Company, powered by excellence, proven by results.
And by Oswego County Business Magazine, covering all of Central New York. For more information, you can call 315-342-8020 or visit OswegoCountyBusiness.com.
And by Cagle and Vincentini, experienced certified public accountants committed to assisting clients with personalized individual and corporate tax planning, estate and retirement consulting, and investment strategy. More information at 315-488-8951.
Good evening, Central New York. I'm Jim Burns, and welcome to this edition of Financial Fitness. Thank you for joining us tonight. One of my all-time favorite quotes goes like this: "The only thing I know about money matters is money matters." Indeed it does. Whether buying an ice cream cone, a new car, a home, or funding a comfortable retirement, money matters. So tonight on Financial Fitness, we will take an overall look at the art of financial planning. What are the basics you need to master? I have two great guests with us tonight who are masters of money matters and outstanding financial planners to boot. First up, Frank Nettie is a certified investment management consultant and senior vice president and investment officer at Wells Fargo Advisors, LLC, member FINRA and SIPC, with offices here in Syracuse. Frank, I know you've been on the show before.
Yes, thank you.
Let me say again, welcome.
Appreciate it.
Great to have you. Also with us tonight is Eileen Price from Price Miller Associates, part of AXA Advisors, member FINRA and SIPC here in Syracuse. Eileen, welcome.
Thanks.
I know you've been on the show a few times in the past, and it's great to have you back.
I love it. I love the new studio.
Excellent. Well, let's begin. I want to start with you. You hear a lot of designations and terminology as far as different types of financial advisors or certified financial planners, chartered life underwriters, et cetera, et cetera. For our viewers, explain what the difference is, Eileen, between a pure investment advisor and a financial planner.
That's a great question. We both do both, but investment advisor takes a chunk of money and looks at the return, looks at your risk tolerance, and only cares about that chunk of money, that investment, that bucket. A financial planner looks at the whole picture. It looks at how much you spend, what are your goals, where are you going, who do you take care of, what happens if you don't come home for dinner tonight. It looks at a much in-depth picture of your whole life.
It gets down to sort of the nooks and crannies everywhere in every part of the financial life, not just the investing.
I think that you could say that the good word is coach, coaching you along the way to your goal for a financial planner.
Well, it leads into my next question, which is I've heard it said that the financial planner should be sort of the quarterback of your financial team.
Yeah.
What other members should be part of your financial team?
Well, part of your team is who and what they do. So why do you do what you do? I think that the person has to ask why you do it. Why am I here? So the investment advisor would also look at the investment itself. How do we get to a goal, which is also what the financial planner would do, but they would actually make investment choices and help you make that choice.
But financial planners also can help you make investment
definitely.
decisions. So there is a merging of the two.
Exactly. Absolutely. There's an overlap.
So who are some of the other members, though, should be on the team when they talk about
you're doing estate planning, you have to have an attorney. We don't do estate planning in the law portion of it.
Right.
So you have to have an investment advisor to help you invest your money if you're opening up a charitable trust. How do you manage that money? Same thing with a retirement plan. How do you manage that bucket of money? So the investment advisor will give you advice on that.
What about a CPA? Wouldn't that be part of it?
CPA would be perfect for or an accountant. Many people can't afford CPAs, but they can afford accountants, and they should be.
Or just a tax preparer, right? It could be an enrolled agent, a CPA. There's a lot of different designations with that too.
Okay. Let me, as a follow-up question, are there not certain instances, Eileen, where somebody should have maybe a financial planner and an investment advisor separately. What would you say to that?
Well, it depends what you're comfortable with. And a team approach, there's always great to have more heads and more people looking at it. Very often we have clients that have a few different people working on their portfolio, and that's okay. It's what you're comfortable with. It's your money. It's your choice.
Okay. Well, let me now do a follow-up on that, which is that if one of the criticisms I've heard and read of financial planners is that they do a financial plan, but then ultimately what they're really trying to do is sell product, such as life insurance or annuities, etc. How would you respond to that?
Products are part of the plan. People are the plan. You've got to look at, there's no one product that's right for every single person. That's why it's so important, and that's why it's called personal finance. It's personal to the client we're meeting. We look at that and say, now, is this long-term money? Is this short-term money? If some product, do you need life insurance? Is that part of the plan? We go through every step with every client. If you have $5 or $5 million, we go through how much you spend, your cash management, your risk management. We look at if you need to buy a child's education or a second home. Then the most important is retirement. We take that so seriously because, as we were talking about before, people live forever.
Yeah.
It's a long time.
My client just came in the office the other day. He's 97 years old. And so
we're going to be seeing more of that.
Exactly. People are getting leaving retirement older, but also living much older. So they're having more money coming out in retirement, and they're having that money to last longer in retirement.
And that last step is passing assets to the next generation,
Yes,
to do it tax efficiently. So you have to look at every piece of that puzzle.
And we apply investment theory to everything we do. I mean, whether it's buying a mutual fund, whether it's a separate accounts management like what you do, Jim, we have to apply investment theory and really intellectual knowledge applied through asset allocation.
We're going to talk about
probably that's one of the most important decisions you can make.
Okay. Let's now I want to just say, if you took a hypothetical situation, which is somebody comes to you, Eileen, they're retiring from a corporation around here in Syracuse, small business. Let's use $100,000 as a round figure. They come to you. Mm-hmm. How would you, as a financial planner, begin the process? What would you look at? Take me right through the process of investing them as a financial planner, looking at their insurance, et cetera.
So $100,000. I have to find out if they need that money tomorrow. I have to know if they're going to, how much they spend every month, and we just look at the whole process. Then we look at their risk tolerance. If they're going to get sick every day when they open up that envelope and their money went down, it's a different person. It's if you want them more aggressive, if they're fine with it, if they say they can let it ride, then we let it ride.
But Eileen, wouldn't you go through the financial planning? What are some of the early things you would be looking at? Their insurance coverage, right, their budget, their expenditures?
We don't call them a budget. We call it a spending plan, because a budget is like a diet, and no one can stay on a diet forever. So we look at it as spending. What do you spend money on? Put your trips in there. Put your gifts to your grandchildren in that spending plan. Make it realistic, because then they won't run out of money, because we'll know how much distribution to give them, and then we'll know how to plan and invest for them. And then we do the risk tolerance. Like I said, if you get nervous and you can't risk anymore, you have to save a lot more. It's okay to be conservative. Just save a lot more money.
And you could build risk tolerance right into a plan.
Absolutely.
So you could ask the client, could you handle a 10% decline in the market, a 20% decline in the market, a 50% decline in the market, which we've seen, right?
Right.
So we have to, if they can handle that, then the planner or the investment advisor will budget money into different asset classes so that they can reduce risk.
And each bucket can be treated differently. You can have a bucket that you know that if the roof needs repair, okay, we don't really want to put that in an aggressive account. But then something that's going to be out for 10 years, 15 years, okay, let's put a little more
the thing
equity
is, Jim,
into
is that a lot of people change their minds along the way. And this is very dangerous for planners. We try to prevent people from stubbing their toe. Mm-hmm. So after 4 or 5 years of a great market, what do people come in and they want market-like returns, and they want all their money in stocks, right, and they're 68 years old, and say, wait a minute, let's step back, let's look at the plan, let's look at your goals, let's look at your risk tolerance.
That's the coaching.
That's what coaching's all about.
What insurances, coming back to the early part of the financial plan, mm-hmm, what are some of the things you feel that people ought to have covered, right, that maybe sometimes they are not adequately covered, or the like?
Well, I would feel terrible if one of my clients passed away and their family wasn't protected. It's my duty to show them how much money they will need for their family to keep their family living, breathing, going to school the way they want them to. So life insurance is important, but also long-term care is so important in this day and age because what we were just talking about, people live longer. So we've got to make sure that they have some protection so they don't have to move it back in with their kids.
In other words, what she's saying is we're identifying problems,
Right.
future problems that people haven't identified yet.
Right.
Well, that's what I'm getting at is, do you look at their homeowners insurance? Do you, as a financial plan, do you take the holistic view? What are some of these other insurances that may not be adequately covered or that you find? Anything that stands out?
Oh, absolutely. You need that umbrella coverage. We don't know what's going to happen. We don't know who's going to trip on your lawn.
Do most people have umbrella insurance?
Not enough.
And they're
it's
not,
not
very inexpensive.
That's what I was going to say. It's not
very
costly.
inexpensive.
It's just
like $40, $50 for $1 million more of coverage than your normal.
If let's take somebody worth many million, how much should they have? I've asked this of my.
The more you have, the more you have to protect.
Okay.
That's a great rule of thumb.
It's a very general rule of thumb. Yeah. Let's use a number of 5 million, 10 million. What should somebody have in terms of coverage? Should it be 1-to-1, right up to their asset?
I think, firstly, if you can afford the $5 million coverage and you have $5 million, that you should be able to afford that.
Well, it sounds like it's very inexpensive.
Yeah, it's inexpensive.
It's worth it. It's worth having it. You sleep a lot easier knowing that your family is protected with all the different insurance. Disability insurance, it's very important. If you can get it, because what we do, how we make all our money through work, it's a lot of money. You add that up over the years, if we can't work, our family has a problem.
I want to come back onto the idea of a spending plan.
Yeah.
How many of your clients, Eileen, have a spending plan?
They're going to laugh. Are you out there? They're laughing.
How many stick with it?
Well, we do it with everyone. And so we do it with
this is what I was getting at.
That's
Give
the
me
process.
an idea of somebody $100,000.
We start with that process, and we look at it, and I can tell you every person that does an honest spending plan has an aha moment where they're like, I spend that much on coffee every day at Dunkin' Donuts. And when we can break it down, that they start making different choices, significant choices, and we can find the money there to save for retirement. It's a beautiful thing, that spending plan and then the distribution plan later on.
Do most of your clients stick with the Eileen Price, the Price Miller spending plan after 2 years?
We check it and we recheck it because the distribution plan, they can see they're linked together.
She's doing a good job. She's getting them to do that.
I do.
Let me tell you.
I do.
Because 80% of financial plans are not
adhered to.
They're not adhered to. So you're doing a good job.
And we also say if the world changes or your life change, we change the plan.
Yeah. Do you, Frank, in terms of asset allocation, how do you begin that process? Again, looking at somebody who begins retirement, they're going to live a lot longer, as we said, than they probably imagine.
Well, we believe that in the accumulation phase, you can take a little bit more risk, so you can take more equity ownership. That would prove better for the retirement plan itself. But over the time, you're going to eventually deaccumulate. You're going to start taking money out, and that means asset allocation is important. It's going to be probably more bonds and a better ratio between stocks and bonds. Except in this market, we have a tough time finding bond yields high. So unlike any other market, I've been through this market for 34 years now, and I find it very difficult to find bond yields that can help my clients retire. So we have to do more stock dividend paying equities, and so forth. So asset allocation depends on a lot of different factors.
Is it true that for our viewers, that you should have about 80%, you should plan on needing 80% of your current income? If you're thinking of retiring, you should be having about that spending amount, 80% of your current income?
Yeah, I think you're right.
Because most people don't have that.
Yeah, but I think it's personal. Like Elaine said, it's personal, and many people spend more than 100% of what they're making because they're traveling in their initial years.
Every day Saturday.
That's right.
Yep.
So you have to be a personal
Do you have
plan.
a ballpark number that people should have?
I don't. I think it's so personal that you have to build it around.
The commercial is, what is your number?
Right, yes.
Isn't it something like 10 times your income? Maybe that's what I'm thinking of.
Well, 10 times your income is definitely life insurance. It's a good rule of thumb. We do a big life insurance needs analysis, and we get it, and we get very scientific, and it comes out 10 times your income. It's interesting over and over again. So for a rule of thumb, basic, treetop, you look at it and say 10 times your income.
All right, that's the amount you should have saved for retirement.
I think, too, is that you have to look at their liabilities. You know, we encourage our clients before they retire to try to, take down their liabilities, take down their expenses and their debts. Because if they can do that, they're going to be more comfortable when they go to that mailbox and take that check out.
Exactly.
Eileen, how much of your work in the financial planning part is focused on making sure that your clients' insurance needs are adequately covered?
Once again, every client we talk to.
But in general, I know that each client, and I understand that each client is different, but
and what they feel about it. We try to educate them on all the different types of insurance there are. Like when they have a lot of young kids, that's a big, huge amount of money that you have to cover. And then if you want a legacy plan, if you want to give money to, that's a beautiful way to give money to the next generation.
Is what?
Life insurance, tax-free.
Or
you get
charity.
That, or charity.
Write in a charity as your beneficiary. So that it's what the person wants to do. Why are you here? Why do you want insurance? Some people don't want insurance. Some people don't need insurance. But there are people that want to give money to their children or to charity.
Term is like rent. Term insurance is like rent. It's easy to understand. It's simple. You pay it, you have it. They don't believe you're going to die in 20 years, so they'll give you a large amount of insurance for a little amount of money.
And I give you a personal story. That's my brother was 45 years old when he had 7 children, working for me. I said, "Do you have any life insurance?" "No." I said, "We'll buy term insurance."
Right.
Well, you know, pennies on a dollar, right? A year and a half later, he died of cancer.
What if you hadn't had that conversation?
There it is.
What are some software? We have a lot of people who are do-it-yourself. Frank, what are some software tools that are available if somebody wants to look at their financial plan?
You can go online and just press in, type in how to create a financial plan, and it'll start to kickstart what it means to have a financial plan. You can do some of this on your own. These are good tools.
And I agree, and they're fascinating, but also I just worry about the security of some of the sites because they aren't, there's one, there's a lot of different sites and they're coming up, but one in general, you have to put a lot of information. It tracks your banking, it tracks your retirement plans and how much you spend.
Which one is this, by the way?
That's mint.com.
Mint.com.
Yeah, but I just don't know
how secure it is.
Correct.
Okay.
I saw people use it. It was wonderful. People had a tracking of their budget every day and how much they're spending and what they're putting in retirement. I want a tool for everyone to have that is secure, that they could feel comfortable using, and I haven't found that yet.
I think you can go on T. Rowe Price, you can go on Wells Fargo. There's a lot of large companies that have fairly secure sites.
Right, if you know the site.
Yes.
And there's banking sites that do that. We love the banking sites. They're online banking that sort all your expenses through restaurants and food and travel. And that's a beautiful tool. Once again, relates to that spending plan.
Yeah. What is, let's talk about asset allocation, diversification, asset allocation. A well-known investor, Hirsch Cohen, was recently just on, I think it was front of Wall Street Journal, where he said anyone under 50 years old, Frank, should have 100% of their money in stocks, dividend payers who will increase their dividends over the next, year after year. Do you agree with his assessment?
I would agree with it, but I would condition it. I'd say because when you're investing in equities, there's so many different kinds of equities out there, and there's so many asset classes. I mean, small cap, large cap. If you put all your
those are.
What?
Why don't you explain what those are?
Yeah, small cap or small companies. If you put all your money in a small company stock fund, for instance, well, that's going to have more volatility than a large company stock fund or a manager who manages large corporations, or international, which will have more volatility than U.S. large cap. If you want to be part of the American Renaissance, you might put more money into your oil and gas fields and pipelines. But you got to live with the volatility. At 50 years old, if you have 10 years to retire, I would say a rule of thumb would be 80 to 90% in equities, because you're going to take advantage of the growth of equities more than what inflation is taking away.
Are you finding with this very low interest rate environment, and this goes back to our clients, are you having to increase your equity exposure to get the income, and is that a prudent thing to do, especially with the Dow near all-time highs?
I think if you it's your time, it's the longevity. If you have 10 or 15 years to retire, you can wait out the cycles in business. Business cycles are going to come and go.
I'm
you're
talking
gonna
about
have-
somebody in their 70s, they may live another 25 years.
But they
That's
wanna
the
beat
real
inflation,
dangers.
right?
And they
Yeah.
have to beat inflation.
Right. So
Yields are
then
so low.
we're more cautious, of course. You're talking 40, 50% in stocks. But it depends on, each advisor has a different
I'm not talking
outlook.
about each advisor. I'm talking to you and trying to get
Yes.
your feel. If you have somebody 70 years old
Yes.
who may easily live another 20 to 25 years and yield on bond funds, and
Yeah.
bonds right now are 2, 3%, safe ones anyway. I mean, are you having to put money, or are you suggesting to clients to put money more towards dividend-paying stocks that are going to increase their dividends in order for them to make it for that 20 to 25-year time frame?
You know, that's a hard question because you have to learn to live with risk. If the 75-year-old could accept a decline of 10 or 20% and feel okay with that, you have to go with the person's personality. Some people can't.
But if it was you, I'm trying to get down to, we totally are aware here on Financial Fitness that everyone is different. We say that all the time. We're trying to get your view on it specifically.
Yes.
If it was you, or if it was your mother, how would you advise her to do that?
I would suggest them taking a big position in bonds, where they
Okay.
can clip the coupon and live off the coupon.
Even though it's a low-yielding
Yes,
coupon right
that's
now.
right.
Eileen?
You have to be creative. There's a lot of new tools that have come out in the recent history because of this. Who knew this low interest rate would last this long? We thought, oh, just wait a few years. It will be next year. I'm sure they'll go up. Next year. So there are tools out that have guarantees on them now, that have fixed rates, that don't take the volatility out of the market. And that's kind of like those stabilizer products. They're brand new. You've got to learn about them. They do cost more, but they cut down the risk. And that's what we have to do. We have to look to be more creative. And when interest rates do go up, and it's more expensive to buy a car, more expensive to buy a house, but you will have those. We go back to the CDs and the money markets with the interest rate. But right now, they're not available. So we have to look elsewhere.
Okay. Let's talk about international investing. Again, we've cleared this out that everyone is different. We want to generalize comments for our viewers. Home country bias, most people, whether they are in Asia, they buy 80% Asian stocks. In Europe, it's 70% European stocks. And in the U.S., there was a time not too long ago where everyone felt you should be internationally invested. Now they're showing that people are so low in international investments.
Yeah.
If somebody came to you, Eileen, how much, 60 years old, again, we know that it's specific to them, how much would you recommend in a basic asset allocation to have international?
First, I have to tell them first that investing now in the world is like a woven blanket. So you can say, I only want America. Well, American stocks, well, get those American stocks are there's McDonald's in China. They're all over. So you have to understand that the world is global now. The investing is global. So we have to point that out. Then we have to say, look at something like emerging markets. The last 2 years have not been great.
No, they have not.
Look at over 10 years. They've been fantastic. So you can't count anything out. And like Frank was saying, it's all cycles, and you've got to wade through it. If you're in the accumulation phase, conservation phase, or distribution phase, you look differently at those things. You wouldn't want to cut yourself off from all the potential of investing in international.
Certainly
Go ahead.
emerging markets is very exciting because most of those countries are growing faster than what the GDP in the U.S. is. Mexico is growing faster, for instance. So it's important to take a look at those countries as places where you could have opportunities. And if you had a decline for a couple of years, the opportunities are even greater. So I would suggest 8 to 10% in overseas. And if you're taking more risks, another 5% in emerging markets.
There's a lot of people now, investors I respect a lot, who believe that you should have, this is a good time because U.S. markets have done better. Last year was a year, 2013, stocks in the U.S. did tremendously well. But globally, they did not do so well. And the more diversified you were, the lower your returns. Do you think going forward, still stick primarily with U.S. stocks as opposed to not even just international?
It's a really
but
good
would
point.
you have alternatives? Would you try to broaden your diversification or focus on U.S. stocks?
Broaden the diversification for sure. And this is a great time because U.S. stocks did so beautifully. We also have to reallocate back to that your allocation and put it right back in place. It's so counterintuitive investing because you said U.S. stocks did so well. Well, we're gonna scale back.
There will be a time.
Yeah, they're gonna scale back because we want that diversification to have every market because not everyone's a winner every time.
If you look back over 10 years, you're going to see every asset class is number one sometime in that 10-year period.
Yeah.
So emerging markets will be number one in 1 or 2 years, and then they fall to the bottom. Now, how do you know which one of those asset classes are going to be Number
time
one,
it.
you can't time
Can't
it.
predict it.
Right.
Well, we're going to have to end our discussion here, but you can keep it going by sending us your questions and comments. If you're a social media fan, send us a tweet using hashtag Financial Fitness or visit us on the web at wcny.org/financialfitness. I want to thank my terrific guests for joining us tonight. First, Frank Nettie is a certified investment management consultant, senior vice president and investment officer at Wells Fargo Advisors, LLC, member FINRA and SIPC with offices here in Syracuse. Frank, thank you for joining us tonight.
Thank you, Jim.
Great to have you. Also, Eileen Price from Price Miller Associates, part of the AXA Advisors, member FINRA and SIPC with offices here in Syracuse. Eileen, thank you for joining us. Great to have you. Next week on Financial Fitness, a critical issue for today's working population of baby boomers, long-distance caregiving. Join my co-host Vicki Brackens and her panel of experts as they discuss how to balance caregiving challenges when you live in different cities. Thank you for joining us this evening. From all of us here at WCNY, good night.
Financial Fitness is made possible through the support of our members.
And by Cagle and Vincentini, experienced certified public accountants committed to assisting clients with personalized individual and corporate tax planning, estate and retirement consulting, and investment strategy. More information at 315-488-8951.
And by Oswego County Business Magazine, covering all of Central New York. For more information, you can call 315-342-8020 or visit OswegoCountyBusiness.com.
And by D'Arcangelo & Company, with offices in Utica, Rome, Oneida, and Syracuse. The D'Arcangelo team of CPA professionals specializes in finding ways to minimize your taxes. D'Arcangelo & Company, powered by excellence, proven by results.
If you enjoy this program, please consider becoming a member. Visit WCNY.org.